Today there is increasing IRS scrutiny on international operations and investments. The next two presenters are here to apprise us of the key factors you need to think about when operating abroad. Here with us this afternoon is Bill HENSON, partner, and Kelly BECKER, senior manager, both in our International Tax Services group. Bill, Kelly?
Thanks, Annette. Hello, everyone. We're here today to talk about some of the decisions that, as a U.S. taxpayer, you're going to face as you go abroad for perhaps the first time. And one of the major considerations in terms of how your income that's earned abroad is going to be taxed is the structure, corporate structure in which it's earned. So the U.S. structure that you currently operate through actually can have impact on your foreign operations in the future. So whether you're a partnership or S corporation or a C corporation is an important factor to consider as you establish your operations abroad. And of course, the foreign corporation or the foreign structure can be an important consideration as well. And in fact, it often determines the manner in which you're going to be taxed as a U.S. taxpayer. So for example, if you choose to operate through a branch, which would be an extension of your current U.S. legal entity in another country, that will be taxed differently than if you were to establish a local entity to operate your foreign business. As a U.S. taxpayer, though, you do have some options in terms of how a local entity would be taxed as well. Oftentimes you'll hear people talk about check-the-box elections. These elections will allow you as a U.S. taxpayer to determine how your foreign entity is going to be taxed. Will it be taxed as a flow-through entity, or will it be taxed as a corporation? So one of the earlier decisions you'll be faced with as a U.S. taxpayer is whether or not to make this check-the-box election. In certain cases, though, you won't be able to make this election. Some types of foreign entities are always treated as corporations for U.S. taxpayers. They're referred to as per se corporations, and they're listed in the regulations. Right now, though, we'd like to talk a little bit about how a foreign corporation is taxed in the U.S., and Kelly's going to talk about some of the benefits that are available.
So as Bill mentioned, there's different types of entities or structures that you can use when setting up your business abroad. One of them is the foreign corporation, which is something you generally hear about in the newspapers when there's discussions about reducing your overall tax rate. They're talking about using a foreign corporation to defer your income abroad from U.S. taxation until it's repatriated to the U.S. So one of the key decision makings in determining if you want to use a foreign corporation is being able to leave your cash abroad, so not having to use it in the U.S. Some of the general exceptions to being able to use a foreign corporation, or to be able to use the foreign corporation as a deferral mechanism, is you have to not be able to bring that cash back to the U.S., so that foreign corporation cannot loan money back to the U.S. Another one is Subpart F income. So there's certain types of income earned abroad that would be taxed immediately in the U.S., and those are generally passive in nature, interest in rents and royalties, as well as certain intercompany transactions.
So Kelly, it sounds like deferral might not be an appropriate option for all of our listening audience today. Might be helpful to understand how that income is taxed when it's brought back from the foreign corporation.
Right. So when it's distributed back to the U.S., it's distributed in a form of what's called a dividend, and that dividend is taxed at a certain rate in the U.S. So going back to Bill discussing what type of corporation or entity you're using in the U.S., will determine what tax rate is used to apply to that dividend. So in a C corporation, you're taxed at the rate that you use as a C corporation, so the highest rate is 35%. A partnership, an S corporation, an individual would be taxed at the rate that the individual is being taxed at for federal tax purposes. There are certain treatments available for an individual if the U.S. has a treaty with a foreign country that they can use a capital gains rate. So currently that's 15%. to tax that dividend versus the individual's tax rate in the U.S. So in addition to talking about the tax rate for that dividend, some other considerations is what's called a foreign tax credit. So a foreign tax credit is generally available to C corporations, and that allows you to take a foreign tax credit against your U.S. taxes for the foreign taxes you paid in that local jurisdiction. So one of the reasons that the foreign tax credit was set up was to eliminate double taxation, and it's only available to C corporations because we still have to preserve the fact that a C corporation and a shareholder have to pay separate level taxes. So another foreign tax credit planning opportunity is that if you pay withholding taxes in that local jurisdiction, so if they subject that dividend to additional tax, that you can receive a foreign tax credit against your individual taxes as well as your corporation taxes.
So Kelly and I often find that one of the prime considerations for our clients is this lack of a foreign tax credit at the corporate level, particularly for our individual shareholders of S corps and partners in a partnership here in the U.S. Oftentimes, though, there's a remedy for this lack of a foreign tax credit, and it requires this check-the-box selection that we've discussed earlier, and it also changed the way that these foreign operations will be taxed. Kelly's going to talk a little bit about that next.
So, as Bill mentioned, if you're taxed as, or you use the check-the-box selection benefit, that will allow you to reduce your U.S. tax with those foreign taxes you paid in that local jurisdiction. So not only do you get the foreign tax credit benefit, but also any losses that that foreign branch has will also be able to utilize to offset your U.S. taxable income. And the income earned currently by that foreign branch will also be taxed in the U.S. Some other key notes in using the check-the-box election, or even just operating as a foreign branch in that jurisdiction, is that those losses could eventually be recaptured in the U.S. Based on certain circumstances, and that we do also have to track what's called a foreign currency transaction, that if any distributions are made back to the U.S., normally it would be tax-free in the check-the-box regime. Unfortunately, there could be some foreign currency gains or losses that could be taxed in the U.S. as well.
So often, Kelly and I find that a lot of these decisions that our clients make are really quantitative in nature, and we can definitely help in your assessment of what the right operating structure would be for your foreign operations. And this really does conclude our presentation for today. Annette's going to see if we have any questions.
We have a question from the audience. Bill, are there any circumstances that an S corporation, partnership, or individual would opt for deferral of income using a foreign corporation?
Annette, most of the time our clients that operate through a flow-through entity or are owning a foreign corporation as an individual don't opt for the deferral planning for a number of reasons. But on occasion we do get a client that would prefer deferral, and usually the circumstances that would indicate a preference for deferral would be a situation where the local tax rate is very low, so that the overall effective rate on distributed income is pretty close to the 35% ordinary rate in the U.S. So again, when you think about, particularly if the operations are in a country with a treaty with the U.S., there's always going to be a 15% tax in the U.S. on that income. You'd want to find a country with a local tax rate of 20% or less to really even think about deferral. The other situation where deferral is often chosen is where the client is wanting to reinvest all the earnings in their operations abroad, and they know they're not going to bring the money back. Sometimes that can be a pretty good planning technique, because in general the local rates are going to be lower than the U.S. Sometimes it's only 5 or 10%, but in this case, if you know you're going to put all the money back into the business, it's beneficial to just leave it abroad.
Okay, Kelly, how long do we have to make a check the box election if we wanted to do so?
You have 75 days after the date that you want it to be effective to file Form 8832.
All right, very good. Thank you.